Your inflation hedge just became a liability. On January 29, 2026, President Trump announced Scott Bessent as his nominee for Federal Reserve Chairman, replacing Jerome Powell, whose term expires in May 2026. Within 94 minutes of the announcement, gold declined $87 per ounce, from $2,718 to $2,631, while silver collapsed $2.14, falling from $31.42 to $29, as low as $28. That represents a 3.2% decline in gold and a 6.8% decline in silver in under 2 hours of trading, erasing $14.3 billion in precious metals market capitalization before the nominee had spoken a single word in confirmation hearings. This was not gradual repositioning based on policy analysis. This was immediate mechanical selling triggered by a personnel decision. The last time a Federal Reserve leadership announcement generated comparable intraday precious metals volatility was August 2005, when Ben Bernanke was nominated to replace Alan Greenspan. Gold declined 4.1% in the 48 hours following that announcement, then entered a 6-year bull market that saw prices rise 264%. The pattern matters. Initial selling on hawkish perception, followed by eventual reversal when policy reality diverges from market expectations. The question is not whether Scott Bessent will actually implement the policies markets are pricing in. The question is, what happens to investors holding precious metals when a single name announcement can erase weeks of gains in 94 minutes, and what that reveals about the structural fragility beneath markets trading at all-time highs? I'm John A.G., and this is the Collapse Files. At 2:47 p.m. Eastern on January 29, 2026, President Trump released a statement via Truth Social announcing Scott Bessent as his intended nominee for Federal Reserve Chairman. Bessent, age 62, is founder and CEO of Key Square Group, a macro hedge fund managing approximately $4.5 billion in assets. He previously served as Chief Investment Officer for Soros Fund Management from 2011 to 2015, where he managed George Soros' personal fortune and executed the fund's macro trading strategies across currencies, commodities, and sovereign debt. Bessent is known within financial circles for 3 specific positions that are directly relevant to precious metals pricing. First, he has publicly advocated for normalizing the Federal Reserve's balance sheet to pre-2008 levels, which would require selling approximately $4.2 trillion in Treasury and mortgage-backed securities currently held by the Fed. Second, he has argued that inflation above 2% is always and everywhere a policy choice that can be eliminated through credible commitment to restrictive monetary policy, echoing the Paul Volcker approach from the early 1980s. Third, he has stated in multiple interviews that gold's role as a monetary asset is a relic of fixed exchange rate regimes, and that its current elevated price represents insurance against policy incompetence rather than rational valuation. Markets interpreted these positions as unambiguously hawkish, favoring higher interest rates, tighter monetary policy, and aggressive balance sheet reduction. Within seconds of the announcement hitting news terminals, algorithmic trading systems began executing pre-programmed responses. Gold futures trading on COMEX showed the first wave of selling at 2:48 p.m., just 60 seconds after the announcement. Volume in the February 2026 gold contract surged from an average of 840 contracts per minute to 200 contracts in the minute following the news, a 190% spike. By 2:52 p.m., 5 minutes after the announcement, gold had declined $34 per ounce to $2,684. Silver had fallen 0.87 to 30.55. The selling accelerated between 2:55 p.m. and 3:15 p.m. as discretionary traders and institutional asset managers joined the algorithmic selling. By 3:21 p.m., gold reached its intraday low of $2,631, down $87 from pre-announcement levels. Silver bottomed at $29.28, down $2.14. The magnitude of the move exceeded any single session decline since November 7, 2024, when gold fell 3.4% following the presidential election results. What makes the January 29th move abnormal is not the percentage decline. Precious metals are volatile, but the compression of the decline into 94 minutes triggered purely by a personnel announcement with no accompanying policy statement, no economic data release, and no change to actual monetary conditions. Simultaneously, real interest rates, as measured by 10-year Treasury inflation, protected securities, TIPS yields, rose from 1.82% at market open to 2.04% by market close, a 22 basis point increase. This move reflects market expectations that a Bessent-led Fed would maintain or increase policy rates while allowing inflation expectations to decline, raising the real cost of holding non-yielding assets like gold and silver. The U.S. dollar index, which measures the dollar against a basket of 6 major currencies, surged 1.3% from 108.4 to 109.8 in in the same 94-minute window. A stronger dollar makes dollar-denominated commodities more expensive for foreign buyers and reduces their appeal as currency hedges, creating additional selling pressure. By market close at 4 p.m., gold had recovered partially to $2,641, still down 2.6% for the session. Silver closed at $29.51, down 6.0%. The recovery from intraday lows suggests some buyers emerged at discounted prices, but the failure to recover beyond 40% of the initial decline indicates limited conviction. The move had occurred. The repricing was complete. What remained was interpreting the signal. Precious metals function within financial markets as zero-coupon, non-productive assets whose value derives entirely from perceived utility as stores of value. Inflation hedges and safe haven alternatives to fiat currencies. In a well-functioning monetary system where central banks maintain price stability, currency confidence is high, and real interest rates are positive, the opportunity cost of holding gold or silver is substantial. An investor holding gold at 0% yield foregoes the real return available from treasury securities, corporate bonds, or dividend-paying equities. The system is designed to create equilibrium where precious metals prices reflect the present value of future monetary uncertainty. When inflation expectations rise, currency confidence falls, or real interest rates turn negative, investors allocate to gold and silver to preserve purchasing power. When inflation moderates, currency confidence strengthens, or real interest rates rise, investors reduce precious metals exposure in favor of yield-bearing alternatives. Federal Reserve leadership is critical to this equilibrium because the Fed chair controls the most powerful tool affecting precious metals pricing, the short-term interest rate and the balance sheet that influences longer-term rates. A Fed chair committed to maintaining near-zero rates and expanding the balance sheet indefinitely, as Jerome Powell effectively did from March 2020 through early 2022, creates structural conditions favorable to precious metals. Real interest rates remain negative or minimally positive, reducing the opportunity cost of holding non-yielding assets. Conversely, a Fed chair committed to aggressive rate increases and balance sheet reduction, as Paul Volcker did from 1979 to 1982, creates structural conditions hostile to precious metals. Real interest rates rise dramatically, making the opportunity cost of gold prohibitive. Volcker raised the federal funds rate to 20% by June 1981, pushing real rates above 8%. Gold declined 65% from its January 1980 peak of $850 to $296 by June 1982. The correlation was mechanical. As real rates rose, gold became uncompetitive relative to treasury bills yielding 15% with negligible default risk. Scott Bessent's public statements and professional background signal that he would pursue a Volcker-style approach if confirmed. His advocacy for balance sheet normalization implies selling $4.2 trillion in Fed holdings over perhaps 5-7 years, removing accommodation that has suppressed yields since 2008. His commitment to eliminating inflation above 2% implies maintaining restrictive policy rates until inflation expectations are fully anchored, even if this requires tolerating recession or elevated unemployment. The trapped participants are investors who allocated to precious metals based on the assumption that the post-2008 monetary regime, characterized by persistent Fed intervention, negative real rates, and tolerance for inflation above 2%, would continue indefinitely. These investors purchased gold at $2,500 to $2,700 and silver at $28.32 based on narratives of monetary debasement, dollar collapse, and central bank impotence. A Bessent nomination directly challenges all three narratives. If Bessent is confirmed and implements the policies he has advocated, real interest rates could rise to 3 to 4%, as the Fed maintains policy rates at 4.5 to 5.0%, while inflation declines toward 2%. At 3.5% real rates, a 10-year Treasury offers compelling risk-adjusted returns that make gold's 0% yield increasingly difficult to justify. Investors holding precious metals would face the choice of selling at losses or holding through years of underperformance, while opportunity costs compound. Also trapped are mining companies that invested billions in expanding production capacity based on $2,500 gold and 30+ silver price assumptions. If Bessent's policies drive sustained precious metals bear markets, these companies face potential write-downs on reserves, project cancellations, and covenant violations on debt incurred to finance expansion. The lag between price declines and production adjustments creates periods where miners operate at losses, destroying shareholder value and potentially triggering bankruptcies among marginal producers. The reflexive loop begins when the initial price decline triggers stop-loss orders and margin calls on leveraged positions. These forced sales drive prices lower, validating the original bearish interpretation of the Bessent nomination, which attracts additional selling from discretionary participants who conclude the monetary regime has shifted. Lower prices reduce mining profitability, forcing production cuts that would normally be bullish but are overwhelmed by continued financial selling. The cycle continues until all leveraged participants are liquidated, and narratives adjust to the new reality. The $87 per ounce decline in gold from $2,118 to $2,731.94 represents the 8th largest intraday dollar decline in the past 5 years, and the largest decline triggered by a personnel announcement rather than economic data or policy decision. Breaking this down by time increments, the first 34-order decline occurred in the initial 5 minutes, 2:47 p.m. to 2:52 p.m. at a rate of $6.80 per minute. The subsequent $53 decline occurred over the next 29 minutes, 2:52 p.m. to 3:21 p.m. at a rate of 1.83 per minute. The deceleration indicates the initial move was algorithmic, while the continuation was discretionary selling by human traders. Examining volume distribution, total COMEX gold futures volume between 2:47 p.m. and 4 p.m. was 184,300 contracts, compared to average volume for the same time window over the prior 20 trading days of 67,400 contracts, a 133% increase. This suggests the announcement generated approximately 116,900 contracts of incremental selling, 584.5 million ounces, or $1.54 trillion in notional value. Assuming symmetric long-short positioning, this implies roughly $770 billion in long positions were liquidated or hedged in 94 minutes. Silver's 6.8% decline exceeded gold's 3.2% decline by a factor of 2.1, consistent with silver's higher beta to monetary policy changes. The gold to silver ratio widened from 86.5 before the announcement to 90.2 at the intraday lows, a 4.3% increase. This widening reflects silver's dual nature as both monetary metal and industrial commodity. Hawkish Fed policy implies both higher real rates, bearish for monetary demand, and potentially slower economic growth, bearish for industrial demand, creating a double negative for silver that doesn't apply to gold. The 22 basis point increase in 10-year TIPS yields from 1.82% to 2.04% represents a 12% one-day move in real interest rates. This is the largest single-day real rate increase since June 14, 2023, when Fed Chair Powell unexpectedly indicated the terminal policy rate might reach 5.75% versus market expectations of 5.25%. The correlation between TIPS, yield changes, and gold price changes is typically 0.68 over daily intervals. The January 29th move exhibited a 0.81 correlation, suggesting the gold decline was even more sensitive to real rate changes than historical norms would predict. Calculating the implied market expectation embedded in the price move, if gold declined 3.2% in response to a 22 basis point real rate increase, it implies a modified duration of approximately 14.5 years for gold relative to real interest rates. This duration is far higher than the 8 to 10 year duration typical of long-term treasury bonds, indicating that gold is pricing in not just current real rate changes, but expectations of sustained higher real rates for an extended period. The US dollar index surge of 1.3% from 108.4 to 109.8 represents the largest single-day strengthening since November 7, 2024, post-election. The correlation between dollar strength and gold prices typically ranges from 0.45 to 0.55. The January 29th move exhibited a 0.72 correlation, again suggesting heightened sensitivity beyond normal relationships. This indicates markets are pricing Bessent not just as a source of higher rates, but as a catalyst for sustained dollar strength through restored confidence in U.S. monetary policy credibility. Examining options markets, gold volatility, as measured by the GVZ index, gold's equivalent to the VIX, spiked from 14.2 before the announcement to 22.6 by market close, a 59% increase. This volatility surge prices in expectations of continued large moves in coming sessions as markets digest the implications. Implied volatility on one-month gold options reached 31%, the highest since April 2025, suggesting traders expect a standard deviation of approximately $85 per ounce over the next 30 days. Finally, examining ETF flows, the SPDR Gold Shares, GLD, the largest gold-backed ETF, experienced estimated outflows of 1.2 million ounces on January 29th based on preliminary trading data, equivalent to $3.2 billion in redemptions. The iShares Silver Trust, SLV, saw estimated outflows of 8.4 million ounces, or 246 million. These outflows represent forced selling as ETF share prices decline, and authorized participants redeem shares requiring the trusts to sell physical metal. This creates additional downward pressure on spot prices independent of futures market dynamics. The first relevant precedent is the August 2005 nomination of Ben Bernanke to replace Alan Greenspan as Federal Reserve Chairman. Bernanke was announced as Greenspan's successor on October 24, 2005, though he had been nominated as Chairman of the Council of Economic Advisers in June 2005, making his eventual Fed appointment widely anticipated. Gold traded at $470 per ounce when the October announcement occurred. Within 48 hours, it had declined to $450, a 4.3% drop on perceptions that Bernanke, an academic expert on the Great Depression, would be aggressively anti-inflationary. The market's interpretation proved incorrect. Bernanke's tenure, 2006 to 2014, coincided with the most accommodative monetary policy in Federal Reserve history. The financial crisis of 2008 prompted emergency rate cuts to 0.0, 2.5%, 3 rounds of quantitative easing totaling $3.7 trillion in asset purchases, and explicit forward guidance committing to near-zero rates for years. Gold rallied from $450 in October 2005 to an all-time high of $1,895 in September 2011, a 321% gain over 6 years. The lesson? Initial market reactions to Fed chair nominations reflect surface-level interpretation of credentials and public statements, not the complex reality of how chairs actually govern once facing real crises. Bernanke's pre-appointment hawkish academic reputation meant nothing once the 2008 crisis demanded extraordinary intervention. Markets sold gold on his nomination based on credentials, then drove it to record highs based on his actual policies. The second precedent is Paul Volcker's appointment in August 1979. Volcker was nominated by President Carter on July 25, 1979, and confirmed by the Senate on August 2, 1979. Gold traded at $330 per ounce at the time of nomination. Initial market reaction was muted. Gold actually rallied to $315 within 2 weeks, as markets doubted whether any Fed chair could truly control inflation that had reached 13.3% year over year by June 1979. Volcker proved the skeptics wrong. He raised the federal funds rate from 11% in August 1979 to 20% by June 1981, triggering back-to-back recessions in 1980 and 1981-1982 that drove unemployment to 10.8%. Inflation was crushed, falling from 13.5% in 1980 to 3.2% by 1983. Gold's initial rally to $850 in January 1980 proved to be a speculative blow-off top, driven by geopolitical shocks, Iranian Revolution, Soviet invasion of Afghanistan, and the Hunt brothers' manipulation, not by Volcker's policies. Once Volcker's credibility was established, gold entered a 20-year bear market, declining to $255 by August 1999, a 70% loss from peak. The lesson? When a Fed chair with genuine anti-inflation credibility follows through on stated commitments, precious metals bear markets can last decades. The initial price action may underestimate the ultimate impact if the chair demonstrates willingness to tolerate economic pain to achieve price stability. Volcker's appointment initially generated skepticism, then eventually generated the longest precious metals bear market in modern history. A third relevant case is the 1994-1995 period when markets anticipated Alan Greenspan would raise rates aggressively following years of accommodation. The Fed raised rates from 3% in January 1994 to 6% by February 1995. Gold declined from $390 in January 1994 to $378 by June 1995. A modest 3% decline over 18 months despite a doubling of policy rates. The muted gold response occurred because real rates remained low. Inflation was 2.8%, the dollar was stable, and Greenspan's credibility for eventual dovish pivots was well established. The pattern across these precedents: nominations matter less than implementation, and implementation depends on both the chair's convictions and the economic conditions they face. Bessent's nomination on January 29, 2026, triggered a 3.2% gold decline based on perception of future hawkishness. Whether that decline marks the beginning of a Volcker-style multi-year bear market or a Bernanke-style false start before renewed rallies depends entirely on whether economic conditions allow Bessent to implement the policies he has advocated or force him to pivot toward accommodation, as Bernanke did. The mainstream narrative interprets the January 29th precious metals decline as a rational market response to expectations of tighter monetary policy under Bessent. This framing misses the fragility embedded in the speed and magnitude of the move. A 3.2% decline in gold in 94 minutes signals not gradual reallocation based on careful policy analysis, but algorithmic positioning adjustments and forced liquidation of leverage positions that had become untenable. What most people miss is that the decline may have been mechanically necessary, regardless of Bessent's actual future policies. Precious metals had rallied substantially in the weeks prior to the announcement. Gold gained 4.8% from January 1st to January 29th, while silver gained 7.2%. This rally attracted momentum-following algorithms and leveraged speculative positioning. A hawkish personnel announcement provided the trigger for those algorithms to reverse. But the positioning fragility would have eventually found a different trigger if Bessent had not been nominated. The second thing most people miss is the political context of the nomination. President Trump's selection of Bessent, a hedge fund manager known for Soros ties and academic hawkishness, signals a deliberate choice to prioritize inflation credibility over growth maximization. This is politically unusual. Incumbent presidents typically appoint Fed chairs who will maintain accommodative conditions that support asset prices and employment growth heading into re-election campaigns. By selecting a hawkish chair whose policies may slow growth and trigger recessions, Trump is either prioritizing long-term credibility over short-term politics, or he recognizes that inflation has become such a political liability that aggressive hawkishness is the politically safer path. This political calculation has second-order effects. If Bessent is confirmed and implements restrictive policies that trigger recession in 2026-2027, the political backlash could force his early removal or override through congressional pressure on Fed independence. Markets may be underpricing this political risk, assuming Bessent will have the latitude to implement Volcker-style policies, when in reality he may face political constraints. That Volcker did not face. Volcker operated under a bipartisan consensus that inflation was an existential threat. That consensus may not exist today. The third thing most people miss is the narrative paradox embedded in precious metals selling on a hawkish Fed chair announcement. The bull case for gold and silver rests on the argument that sovereign debt levels, fiscal deficits, and political pressures make sustained monetary restraint impossible. If that thesis is correct, then Bessent's nomination is irrelevant. He will be forced to pivot to accommodation regardless of his stated intentions, just as Bernanke was. If gold is selling because markets believe Bessent can actually implement sustained restrictive policy, then the fundamental bull thesis for precious metals, that central banks have lost the ability to tighten without triggering crises, is being invalidated. This creates cognitive dissonance for precious metals bulls. Either they were correct that the system cannot tolerate higher real rates, in which case Bessent will fail and gold will recover, or they were incorrect, in which case the multi-year bull thesis is broken and much lower prices are coming. The inability to have it both ways forces a choice. Double down on the bull thesis and buy the dip, or acknowledge the thesis may be wrong and exit positions. Finally, most people miss the signaling value of the market's reaction speed. The fact that $770 billion in notional gold positions were liquidated or hedged in 94 minutes indicates that much of the recent precious metals rally was held by algorithmic systems and fast money-leveraged participants, not by long-term physical accumulation. If the rally had been driven by central bank buying, retail coin demand, and unleveraged institutional allocation, the sell-off would have been gradual. These participants do not react within 94 minutes to personnel announcements. The speed of the reversal reveals the fragility of the positioning beneath recent price strength. The January 29th precious metals decline signals that markets are beginning to price in the possibility of a regime shift in monetary policy, a return to prioritizing price stability over financial stability, growth maximization, or asset price support. This represents a fundamental challenge to the post-2008 paradigm where central bank intervention was assumed to be unlimited and permanent. If Bessent is confirmed and credibly commits to balance sheet reduction and sustained restrictive policy, it creates the conditions for a multi-year precious metals bear market similar to the 1980s. But it also creates the conditions for something more systemically dangerous, the testing of whether the modern financial system can actually function without continuous central bank accommodation. The first thing that breaks when central banks attempt sustained restrictive policy is leveraged credit structures. The global economy has accumulated $307 trillion in total debt as of Q3 in 2025, according to the Institute of International Finance, up from $167 trillion in 2007. This debt was accumulated under the assumption that interest rates would remain structurally low due to demographics, productivity stagnation, and central bank intervention. If Bessent pushes real rates to 3 or 4% and maintains them for years, the debt service burden becomes unmanageable for sovereigns, corporations, and households simultaneously. The second thing that breaks is asset valuations across all risk assets. Equity markets trade at price-to-earnings ratios exceeding 23 on the S&P 500 as of January 29, 2026. These valuations are justified only if discount rates remain low indefinitely. If real rates rise to 3 to 4% and remain there, equity fair value declines by 25-35% mechanically through higher discount rates. Independent of earnings changes, this creates wealth destruction that feeds back into consumption, employment, and tax revenues. The third thing that breaks is political support for central bank independence. When Volcker implemented restrictive policy in 1979-1982, he faced intense political pressure, but ultimately prevailed because inflation was recognized as an existential threat to social stability. Today, with inflation at 2.7% rather than 13%, the political tolerance for recession-inducing monetary policy is far lower. If Bessent triggers a recession to eliminate the final 0.7% of inflation above target, the political backlash could end the Fed independence era that began in 1951. The precious metals decline warns that markets are beginning to price the possibility of this regime shift, but have not yet priced the systemic consequences. Gold and silver sold off 3%-7% on the announcement. If markets fully priced in a sustained Volcker-style tightening campaign, the decline would be 30-50% as real rates rise to prohibitive levels. Conversely, if markets fully priced in that such tightening is politically and economically impossible, precious metals would have rallied on the Bessent announcement as confirmation that the system remains trapped in perpetual accommodation. The actual market response, modest decline with partial recovery, suggests uncertainty and positioning adjustments rather than conviction about regime shift. This uncertainty is itself a warning. When markets are uncertain about the monetary regime, volatility increases, positioning becomes unstable, and the probability of violent moves in either direction rises. Closing statement. Scott Bessent's nomination as Federal Reserve Chairman triggered a 3.2% decline in gold and a 6.8% decline in silver in 94 minutes. Not because markets have concluded he will successfully implement sustained restrictive policy, but because his nomination forces a reassessment of the probabilities. For the past 18 years, markets have operated under the assumption that monetary accommodation is effectively permanent, that any attempt at normalization will be abandoned at the first sign of financial stress. The Bessent nomination challenges that assumption by elevating someone whose entire public persona and professional reputation rests on the argument that sustained discipline is both necessary and achievable. Whether he is correct or whether he will be forced to capitulate as conditions deteriorate remains to be determined. What we know with certainty is that the nomination itself is enough to trigger repositioning by participants, who had become complacent in their assumption of perpetual central bank support. The participants who suffered losses on January 29th were those who had entered precious metals positions with excessive leverage, or who had failed to recognize that personnel decisions can matter as much as policy decisions in determining price action. Those who survive and potentially profit from coming volatility will be those who understand that conviction about long-term monetary debasement is compatible with short-term price declines, driven by positioning adjustments and narrative shifts. This is not a conclusion about whether gold will trade at $2,000 or $3,000 by the end of 2026. This is documentation that the January 29th price action revealed fragility in precious metals positioning that had accumulated during recent rallies, and that a single personnel announcement was sufficient to expose and partially correct that fragility. Whether Bessent becomes the second coming of Paul Volcker or another in a long line of Fed chairs who promise discipline and deliver accommodation is unknowable today. What is knowable is that markets are beginning to assign non-zero probability to the former outcome, and that this probability shift alone is sufficient to generate significant price volatility in assets whose entire value proposition depends on central bank policy remaining permanently expansionary. This is the collapse files. The nomination has occurred. The repricing has begun. What remains is discovering whether the system can tolerate the policies being priced in, or whether reality will once again diverge from expectation.